And on today's show, how split interest charitable trusts can be significant for donors and charities. Part 4 of this week's series on the end of the year charitable giving strategies for 2014. With top producers Mike Kilbourn, CLU CHFC, and Rob Odell, CFP. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Innsmark, Life Specs, and Backroom Technician. Let's get down to business. Well, welcome to day 4. Rob, Mike, you guys enjoying yourself on the show?
Yeah.
You guys are really giving us a tutorial lesson. And now, this sounds like maybe the heaviest part of the week. We're into split interest. This sounds almost on the edge of, wow, is this over Steve Savant's head? I don't know. Is this pretty easy to understand?
It's pretty easy once you get the concept down.
Because it sounds like it has huge application and it can really help everybody involved, whether it's the donor or the charity itself.
Right, and the thing it is, it's financial planning, income tax planning, investment planning, and estate planning. Kind of, they all converge right here in the split interest arena.
And wow. It's synergistic, and so I'll prove it in a second.
Okay, carry on.
Well, good, let's talk about what a split interest trust is. A split interest trust, go right to the basics here. There's two parties who have interest in a split interest. You have the income interest and the remainder interest. And sometimes it's a charity, it can be the income interest. Sometimes it can be the donor, income beneficiary, be a real person be the income interest. And then the remainder interest can be an individual, a trust, or a charity, depending on what type of trust you're using. So the key thing you want to know is, I learned this very early on in understanding these type of trusts, sum of the parts equal the whole. So the factors that go into determining what each interest is the term of years, or the age of the people setting up the charitable trust, the 75-20 rate, and the payout rate. And so at any given point in time, you can go to a charitable remainder trust or a charitable lead trust and calculate to the dollar what is the income interest and what is the remainder interest at any given point in time.
That's right.
And I need to know that because I'm going to be splitting some of that?
It's more for income tax planning, what your income tax deduction is. And that's probably the biggest reason why you want to know that, is for income tax planning.
Okay, so I need to know the age and or the terms of,
how
long
years.
we're going to be online. Correct. And then that's going to give me my 72-20 rate.
That's a federal rate. 75-20 is a federal. It's actually 120% of the midterm rate, which is a rate that's published every month. And a midterm is 3 to 9 years. And they just, in fact, currently it's 2.2%. I happen to know that.
Well, that's very, very low.
And then the distribution rate, what's being paid out to the income interest.
Now, is that the rate, the actual physical interest rate?
It's the percentage on the trust. If it's a unit trust, it's a percentage, or an annuity trust, and we'll break down the differences.
All right.
So the first split interest trust we're going to look at is probably the most common and most popular is the charitable remainder trust, signed into law in 1969 under Section 664 of the Code. And typically, how it's set up is the donors make an irrevocable gift, usually of low basis property, but it can be cash. It goes to this trust. They receive an income tax deduction for the present value of the charitable interest, because during their lifetime, they're going to receive the income, the donors that is, and then at their death, it goes to charity. So the income interest is the donor, income beneficiary.
And it could be the donor and the donor's spouse, for example.
Correct.
Okay, go on.
And then the remainder interest is the charity. Now, when you put appreciated assets in there, because it's tax exempt, they can sell it and not pay a lump sum capital gains tax.
Say that again. No capital gains tax when the asset's sold by the trust. Right. And you can be the trustee, you who created it can be the trustee and control those assets once.
So I have control of something and I'm still not paying taxes on it?
Correct. Well, you're paying tax on the income as it comes out to you.
On the income part, but not on the capital gain?
Not the lump sum. So think about that, the Medicare surtax that we've talked about in previous programs, you're able to shelter the large lump sum capital gain. So if you have a large position of stock or real estate without debt, place it in here, receive an income tax deduction, sell it without a large capital gains tax.
Yeah, I understand the income issue and the ordinary income tax. I'm still going to have to pay that. But now we're talking about this lump sum. Now, when you look at this, does the lump sum tax deduction, does it kind of mitigate some of the ongoing income?
Oh, absolutely it does. Absolutely. Especially if you're going to sell the stock or real estate anyways. And you just take a look at that tax play by putting it in here, income tax deduction plus the avoidance of the lump sum gain.
Plus you could take the tax savings from the tax deduction and use it to replace the wealth. Hang with me there. So now the wealth is going, what you've donated is eventually going to end up in charity, but during your life you get an income. But get this, you say, what happened? My kids are out of the formula. Well, no, hold on there. What you can do is take the tax savings, quite literally the tax savings, maybe a little bit of the extra income, because it's extra because you're not paying capital gains tax and you're putting it to work. And you can purchase a life insurance policy in what we call a wealth replacement trust, and now the kids may be better off than what if they had gotten the asset that you gave to charity. they may be better off getting the tax-free insurance proceeds.
Okay, so when you're looking at this and studying this out, how many people qualify for this kind of tactic and a strategy like this?
Not as many as a donor advised fund, but it's someone who, if they're going to sell the asset, they need additional income, they're in a high tax bracket, maybe they've had a good run the last 5 years in the market, a way to get out from under a concentrated stock holding. Those are the candidates that you're looking at.
So my dividend's not really performing. It's really short on income, but it's so appreciated.
Right.
This is a huge possibility.
No doubt. And then finally, at the end, at death, usually the second income beneficiary, whatever's in that trust goes to the charitable organization. And like last time show, when we were talking about donor advised funds and family foundations, that can be a charitable beneficiary. So the kids can be a part of it.
Continue on the charitable giving.
Capacity.
And another benefit we didn't mention is that the assets that are in this trust are free from the claims of creditors, predators, and divorces in the family. And essentially, if you have a lawsuit, you can just ignore worrying about what assets are in your charitable trust that are paying you while you're alive.
When we come back from the break, we're going to continue in the second segment on all this idea. We want to unpack it even further on split interest charitable trusts. I don't know if I've really seen this map the way you have it here, but it really brings illumination to my thinking and why this would work with so many clients. We'll be right back after the commercial. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. We're talking about really split interest charitable trusts with Rob and Mike. Walk me through these three basic types, because I think that'll help me get a grasp on the inventory of choices I have and the types that are available.
Right. There's three basic types of charitable remainder trust, and I have it broken down into two. The first one is a charitable remainder annuity trust, known as a CRAT. How that's set up, it's funded one time. You cannot make additional contributions to it. You get a fixed dollar amount. So you put $1 million in, you have a 6% payout rate. $60,000 is the amount that comes out regardless of the asset fluctuation within the trust on an annual basis.
So the 6% confuses people. It's 6% the first year, and then that set amount. So now you put $1 million in, 6%, you're going to get $60,000 a year. Every year, $60,000 a year. My God, what happens if the asset doesn't produce a 6%? And the answer is, well, the charity is going to end up with a little less because it starts coming from principal. You must be paid that $60,000 a year. Now, having said that, who is that best for? Probably an older client who, I mean, wants to make sure they have a certain amount of income, doesn't want to worry about fluctuations in the market, et cetera.
With the liquid asset. You would not want to put a hard-to-value asset like real estate into this trust because you have to start making distributions right away. Mandatory. And the minimum distribution is 5%, and there's tests of how high you can go on the high end on the rates. The second type, there's two types within two subparts of this, is the unit trust. It's the charitable remainder trust make a provision. It's a unit trust where it pays out a fixed percentage on an annual basis. This is good for the assets that might be illiquid. They can put the money in, they get a payout rate, it pays out the lesser of income earned or the percentage rate.
Now, what's the basic difference then between the two? Because they're both generating income.
Right.
They both are dealing with a lump sum of liquid assets.
The type of income it is. This is based on a percentage. This is on a fixed dollar amount, the CRAT is.
But in this case, I noticed that your footnote here, you say this is one of those times when an illiquid asset could be a play here.
It could definitely be a play, like real estate, because there's something called a step transaction. If you put real estate in, you can't have a buyer in the wings and saying, here's the buyer, let's do the deal. They have to put it on the market and go through it. And so it's good for an illiquid asset to go in. It pays out the percentage rate or income, whichever's less.
And you pick the percentage that you want. Now, he's talking about a net income with makeup. But a charitable remainder uni trust, it's a pure one, pays a percentage that you choose. And so if you chose 6% or 7% or 8% of the trust as revalued every year.
Correct. Let's go into an example here that we can talk about here. Here we have Bill and Lise. They're in their mid-70s. They have low basis stock they've had for a long period of time, concentrated low basis stock. This year might be a year where they have some spike income, whether it's stock option sales or they've done a Roth conversion. They're charitably inclined and they need more retirement income. So that's the fact pattern here. So if we go over and take a look at Bill and Louise, here's how the scenario works. They're in their later 70s. They gift a low basis stock of $500,000. They selected the 6% payout rate. For that, so the present value of the future gift to charity is $236,000. That's the remainder interest. That is what they can write off in the current year on Schedule A of their tax return.
Plus the 5 coming years if they can't use it all this year.
Correct. So they use up to 30% of adjusted gross income. As Mike said, whatever's left over gets pushed into future years. They begin receiving a lifetime income of $30,000, and that will fluctuate because every year this trust is revalued, and whatever the valuation, if it goes up, the annual income goes down. If the trust corpus goes down, the income could go down. So it's a fluctuation, unit trust. It's revalued annually. At the second death, whatever is in the charitable remainder trust goes to their donor advised fund. So in concept, this is how it works. And what we're seeing now in today's world is a resurgence of charitable remainder trusts. They were very popular in the 90s, not as popular in the last decade because you had tax rates going down and a market going down. Now all of a sudden we have higher tax environment and we have an up market. So these are becoming much more popular again.
Now, if you looked into the future, because I've heard you say many times, Mike, you need to forecast. You need to kind of see the future a bit.
Right.
If I had another return to low tax rates and maybe a difficult market, is this the way to go? Is that one of the bugaboos about this?
Well, in that environment that you talk about, a low tax return and low rates of return, we actually had people take charitable remainder trusts and terminate them, meaning give me my income interest back and I'll give what charity they're due. And so that happened quite a bit in the last decade. We had a number of charitable remainder trusts. On a national basis, charitable remainder trusts went down by about 10,000 in existence.
And in terminating it, so he got a $236,000 income tax deduction, but if he terminated it a year or two later, he'd get the balance, maybe not all of it, of the $500,000 that he actually put in. I actually went through this with a charitable remainder trust, terminated it, and got an extra deduction the year I did terminate mine, because I really didn't need the
And that's
income.
where you took the entire corpus and gave it all to charity,
Yes.
took nothing back. Yeah.
Correct.
So a charitable remainder trust, in you had to really walk through the advantages with the client and the potential possibilities that could be problematic, like you just described.
And involve the other advisors, the tax and legal, and form a team when you talk with clients about this.
Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just hop out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant. We'll see you.